Financial Modeling, Topic 21, Capital Budgeting and Evaluating Corporate Investments by Lou Gaddis. References for this area includes Financial Modeling by Beningas, chapters 1, 4, 6. And an additional reference for this section would be Corporate Finance, 5th edition, Core Principles and Applications. I'm going to use a lot of examples actually from that textbook that I use in my other courses in Core Finance. So our learning objectives will be 5 sections. We're going to understand capital budgeting process and valuation principles. We're going to evaluate investments with CapEx, revenue, and OpEx. Then we'll evaluate buy and lease decisions and talk about the importance of tax shields. We'll evaluate investments with cost only, and then perform sensitivity analysis. So the capital budgeting process. Capital budgeting is an annual process of selecting CapEx investments to try to increase firm value. Now, all positive NPV projects should increase firm value. However, organizations often have a fixed capital constraint. With a capital constraint, meaning a maximum amount they can spend on CapEx, value is maximized by selecting the mix of investments that create the highest NPV. Also, in this process, significant OpEx investments may also be included. Let's talk about the principles that guide the evaluation, the financial evaluation of these investments. First of all, you always use after-tax cash flows, not accounting incomes. Always use market values and not book values when they're available. And only consider incremental revenues and costs, which talking about some of those, we'll say do not include sunk costs because they're already paid. Do not include allocated costs if they're simply not incremental to this project. Do not include do include opportunity costs. So maybe you could have used a piece of equipment on another project or sold it. You need to include that as a cost. Do include synergies or add-on sales. So if this is a launch of some business or investment will increase sales in another area, that should be included. However, if it decreases sales in another area, that should also be included, any cannibalization. Do not include or do include incremental working capital requirements. Do include taxes and tax shields, and do not consider financial considerations in the cash flow. For the main way we're going to do valuation of investments is calculate the net present value, and we're going to use is unlevered free cash flows that excludes debt and interest. The effects of the actual financing of the project, that's going to be accounted for in the discount rate, which we're going to cover in another topic. And to review unlevered free cash flows, those FCFFs are the EBIT after tax. So my EBIT times 1 minus the tax rate. This is also called the NOPAT, the net operating profit after tax. We're going to add back depreciation. We're going to subtract CapEx. And if we sell that CapEx for some salvage in the end, we're going to add that back. And we're going to subtract changes in net working capital, which may or may not include cash. So those are our principles. In our next topic, we're going to evaluate investments.